Welcome back. My name is Chris Sachinelli. I get to build, buy, and sell simple profit businesses every single day. And each and every week, my team over at Simple Broker reviews thousands of deals so that you don't have to. And then we run these exit ready deal reviews to try to surface the best ones to the top. If you want to get a look at this deal review as well as other deals like this, then you can subscribe to the newsletter over at Simple Profits. And we share some of the best deals so that you can get access to them and potentially get the leg up on the competition. Jumping into today's deal review, this is a good one. This is actually one that if I wasn't doing what I'm doing today, which I love, and I wouldn't do anything else, but if I was looking to maybe get into entrepreneurship through acquisition, or maybe I own some sort of adjacent market or complementary market where I could kind of tuck this in as an acquisition or potentially grow through acquisition through this, this is a good deal. I really like this deal. We're not representing this, so we do have our business brokerage over at simplebroker.ai where we represent deals, but this is just a deal that we found on the market. We would finance this, so we would definitely finance this deal through our acquisition capital over at Bootstrapper Capital, where we're building the most affordable and flexible performance-based capital of choice. If you're in our preferred buyer network, then we've vetted you, we've qualified you, and we've also qualified the deals like this one, and we're willing to put our money where our mouth is and help finance those. So this is a window replacement business, but it's not a window replacement like home window. It's for vehicles. So like windshield, it's like windshield replacement. And the business goes to wherever you are. So they have 2 vehicles with 2 full-time employees and 2 part-time employees. And I'm thinking that maybe this is it's like a 2-man job deal. Like I didn't really necessarily do diligence or deep dive into the business itself. I just looked at the sim, but I'm taking out what, kind of put together with context. It looks like maybe it's like a 2-man job to do. They got one person who runs the vehicle and they got somebody else kind of part-time who's, helping out with more of the blocking and tackling, but they got 2 vehicles right now and they're pulling in $500,000 a year in revenue from these 2 vehicles, with an EBITDA of $1.75. And the SDE is, which we'll get into in a second, is even nicer. It was established in 2020. So this is a COVID business. So maybe somebody got displaced during COVID or something, and they just set this up. Not sure, but the owner is looking to retire right now. And it looks like they're really willing to kind of hand this off and support the transition. They said that they're willing to support up to 12 months of a transition period, which you don't really see too often, especially like marketed publicly. Like you can negotiate that type of stuff, but that really means it's an owner that's willing to help and cares. They probably enjoy this to a certain extent, but maybe they're just getting a little bit over. Like maybe they're doing the work and maybe they're operating one of these vehicles. I don't know. But in general, good numbers for the most part. Over 1,000 clients locally. So this is like a large client base. They're not relying on corporate contracts or like fleet contracts for this, which is really cool when it looks to like the diversification of the customer portfolio. So that feels pretty good. It also means that you could probably expand into corporate contracts or fleet-based contracts, or you could take this and potentially go into other local adjacent markets. I'd have to assume that they're inventorying the windshields because there's a physical product that they're putting into somebody's vehicle. I'd have to assume that there's an inventory or a warehouse of that. So you're not going to be able to go like everywhere, but I bet you could logistically figure out how to break apart the markets that are adjacent to like that centralized location, and probably still pick up some pretty good margins. In terms of financials, asking price $850,000. High level, that may sound like a lot, but I have a feeling that this could be a pretty flexible seller. And when you're taking into consideration, the vehicles that they have, they just put the 2 vehicles as inventory. I'd have to assume that there's more, right? Like other tools and things of that nature. So I think there's probably a little bit more assets in this deal than what they're even showing. From a cash flow perspective and a gross revenue perspective, from that side of things, it looks a little bit on the high side, But, I think that realistically, when we get to the details, rubber meets road, this deal starts to really make sense. From an SDE's perspective, right? So to calculate SDE, we're taking that annual EBITDA and then we're making adjustments by adding back in the things that the new owner, if you were to buy this deal, wouldn't necessarily incur, right? This is what normalizes it from a perspective of the new buyer, right? Because you may not take the same $50,000 salary, you may not have the same $10,000 in perks or benefits that this current owner is using, and the one-time expenses that has taken place, you want to add those back in. So that's what we call add backs, and we use that to kind of just like adjust and normalize. And SDE is seller's discretionary earnings. So think of it more like profit in your pocket. And when you look at that, it's almost a $240,000 a year profit in your pocket business. And I'm sitting here being like, I don't really know if these numbers fully make sense, but it kind of does, depending upon the cost of labor and what other costs go into this and like where the billings are coming from. Because I mean, you're servicing residential, you're servicing consumers with vehicles. And I know in my policy, I can have a window replacement. It's like you just submit a claim and you get a free window. So this may be like a little bit of a money making machine is what these may be accurate numbers. I'm actually going to pull this. I'm going to go a little bit deeper into this deal, like just personally, just because I'm curious. I'm not going to buy the deal. I'm not going to put an offer in, and we don't have any buyers as of right now. If you're interested in buying this, I'd love to go into this deal a little bit better because it's pretty interesting. From a calculated multiple, SDE multiple, which again, we use the benchmark because what we're trying to do is figure out market comparisons based off of what other deals are trading at from a multiple perspective of SDE. And you're comparing apples to apples. We'll look at similar industry, similar type businesses, and we'll benchmark it off of the SDE basis, which becomes like a flat line for us, right? At 0.0. In this situation, they're asking that 850, you're going to divide out that 240. It's a 3.54, 3.5, if you're reporting on a spreadsheet or whatever, 3.54 if you're doing the math ratio, right? So that's that multiple. From high level, I don't think that that's necessarily too bad. I do think that you could probably beat them up a little bit on price, but then when I did the benchmarks, I'm realizing, man, this is actually not priced not too bad. So typically we'll see, especially with listed deals listed by brokers, you'll typically see folks trying to list on the high side of what they can get, right? List high and then negotiate somewhere. So typically broker represented deals, which this is a broker represented deal currently. I think that they priced it right, but I do think that they priced it with room for negotiation. And the reason why I say that is at Simple Broker, we aggregate a ton of deals, like literally thousands of deals. And we're building out this internal database of market data within our space. So this micro equity space. And we did it initially for ourselves to be more efficient, effective, knowledgeable in our own activities within our market. And we're slowly opening it up to others to be able to leverage and utilize as well. But we've been able to segment off based off of industry, vertical, etc. And we're pulling a lot of data points. And when I put it in for this business, it's showing a pretty reasonable SDE multiple as a benchmark. So what was the initial gut? I'm looking at this and I'm like, man, maybe this is just a good deal as is. I still think that there's room for negotiation, right? So I do think that there's room for negotiation. And the thing that I'm paying attention to the most is, outside of the fact that this has good bones to it as a deal, is the fact that the owner is so motivated to stay on and support for 12 months, right? So like they want to retire and they're willing to stay on. Like that's really interesting. And in those types of situations, for the right buyer, those types of sellers are willing to negotiate pretty nice deals. So as long as you're the right buyer and you're doing it for the right reason, you could typically position something that makes sense for everybody and truly is a win-win. From a exit ready deal review scorecard, this deal is getting an 87 out of 100 right now. So we go through and we touch base on each of these key drivers, which gives us a high level diligence of the deal, right? When we're diligencing deals and doing valuations over at the brokerage, Simple Broker, as well as with our advisory clients over at Simple Profits, right? We leverage a valuation process for both. Inclusive in that is with Bootstrapper Capital, where we allocate performance-based capital. Everything always starts with a plan. Part of our plan is evaluation. We want to understand the value of a business. We want to understand, most importantly, the why, the key drivers behind it. And then based off of that, we can identify an equity transformation plan, ways to build value, wedge equity in the business. We tried to create a very simplified version of that here. It's comprehensive when we work with our clients and we do diligences and valuations, and we're looking at brand equity and operational equity and the hundreds of different key drivers that influence that. Here we just try to simplify it down. And as we're looking through this and reviewing, and we're asking ourselves, what is it today versus what can it be? And perhaps most importantly, what's the risk associated with it? And can we ring fence that risk? Almost everything, I guess everything actually, I'm looking at it, ended up at either an 8 or a 9, which, two things here. One, don't see that too often. Two, it kind of tells us that this is a really simple business. Simple works, but simple is not easy. And it's not always simple to find a simple business that throws off free cash flow profitability, right? So pretty something here. And that's why I am curious. I would love to do more of a deep dive diligence into this business if somebody's interested. But from everything that we're seeing, there's not really any real risk that can't be necessarily mitigated based off of either what is today. So like what you'd be transferring into, like what the transition integration look like if you were to transfer the assets from seller to you. And in terms of identifying opportunity to grow into that price, that valuation, which the price, not necessarily super high. It's on the higher side based off of the benchmarks. But again, it's within actually where it's supposed to be. So not necessarily a bad thing in terms of where it's at today. But there's also the ability to identify ways to drive new value, create value creation within this business without disrupting anything, because this business is working, right? If it's not broke, don't fix it. And a lot of the stuff that's in this business today is working. So don't really do anything new. Just do what more of what's working and do it a little bit better. In that situation, asterisk, you could probably expand upon the services. You already have this existing client base and you've been able to monetize that customer acquisition. If you can increase your revenue, incremental revenue, by offering or integrating another service and do service expansion, you could either recycle to your existing 1,000+ customers that they have and pull out more incremental revenue off of a new offer, or you can, or in addition to that, as you're, closing new business, you can up value into the relationships that are coming in new. So I think that there's expansionary opportunities without really changing anything. You wouldn't want to change the footprint. Meaning you wouldn't want to change the core of the business. You wouldn't want to change the fact that it's 2 guys in a van going out and delivering the service within a set time frame. They're servicing X number of vehicles per day, and they're there primarily based off of the window replacement. You wouldn't want to change the core footprint of the business, but if you can add incremental value within the opportunity that you have, that's almost virtually as close to free money as you possibly can get, right? So I think that there's opportunity there to focus in. I don't know enough of the business to really diligence what their existing marketing plan is, like customer acquisition. Typically, these types of businesses, there is opportunity to do a technological transformation and integrate new tech to more historic businesses. It's a 2020 business. I don't think it's like necessarily out of date, and it's clearly working. So I don't know if there's too much efficiencies that you can gain or garner from tech, integrating new tech. However, who knows? Well, you can assess that when you get there in the stage of the diligence, identifying that as maybe something. But the other thing that you could potentially look at with this, so, at the end of the day, you have the ability to expand the services, you have the ability to integrate the tech, and you have the ability to potentially improve some of the operational things. I don't really think that that's going to be a case necessarily. The trend of where the business is, I mean, people are going to have cars no matter what, right? Even though we're going to autonomous vehicles, those autonomous vehicles still have windshields. We still want to see. So I don't think the need is going to go away. And realistically speaking, people want convenience. So, you know, the fact that they come to you, that's on trend. So the convenience factor is there. Um, Honestly, this looks like it's probably a pretty good deal. Like, I think maybe you can improve some of the tech, and then based off of an assessment of their existing brand equity, marketing acquisition, customer acquisition pillars, there may be some value that could be created there in terms of increasing customer value. However, acquisition. However, the reality is it seems to be doing pretty well right now. The last thing I could think about is maybe some strategic relationships. So perhaps alliances that could be created, local car dealerships, corporate accounts, like we were mentioning earlier, anyone that has a large fleet where you could get larger contract sizes and then potentially a contract that is defensible as a moat for retention, right? Those are potentially additional opportunities to be able to drive incremental value into this deal. But the reality is as long as you don't break it, this thing will pay for itself, and like you will definitely be able to service down the debt of the acquisition, and it seems to be a good business. I think because of the headcount that you have, and it is like a technical thing. I don't know how technical it is. I don't know how difficult it is to train, teach, train, equipped, recruit new talent. There's two drivers, so I'd have to assume they're kind of like the captains of the ship driving the revenue per van, and then there's two folks that are helping. I'd have to hope that the folks that are helping are kind of learning, almost like an apprenticeship. Another expansionary model is to take the current apprentices and then get them more vans and grow that way, right? And grow the fleet. If the business is there, if you can expand marketing or expand geographics. But there's potential risk that the folks leave with the owner, or maybe they leave, start their own business, compete with you, and you're kind of relying on the talent here because it's a trade, right? However, I think that you can ring fence that. I think there's ways to get around that. And the fact that the owner is willing to stay on for 12 months, I just don't necessarily see that as too much of a red flag risk to stop you at all from going deeper into this deal. If I was an active buyer for this type of business, right? We are active buyers, but we buy the businesses within our core portfolio over at Simple Holdings that complement what we're doing, helping other folks build, buy, and sell simple profit businesses. If we were in this market, we'd probably go deeper into this deal. In terms of looking at the deal from a negotiation perspective, even though it looks good, doesn't mean that you don't want to approach it like it's bad, right? Always approach everything like there's hair on the deal for sure. And what you're trying to do is structure the deal, right? So that you can take away risk. You want to mitigate as much risk as you possibly can into the buy of the deal. And I do think that there's positioning to do so here. I think that there's a framework to be able to follow, specifically since that there's an indicator the owner's willing to stay on for 12 months. I think that there's something tied to that from an emotional perspective, maybe like a leverage of like a sense of pride of ownership in terms of what's being built to be able to align into, make it more of a win-win in terms of your structuring. Perhaps this could even be like a double bite of the apple type of situation where it's not a complete and total buyout, but you leave them on. Like if they're willing to stay on for 12 months, there's a good chance that they're willing to stay on forever, realistically, at a smaller equity percentage. And that may be something that you want to, consider. And that could also reduce the overall price. It could become a starting point of a conversation around price. And you can then, softly now reference without offending the fact that it's priced pretty, on the higher range, which opens up more dialogue for conversation around structure. So now you have an open door to be able to go deeper into structure. And in this type of deal, I would definitely try to approach like the holy grail type of deals of like earnout, seller financing, deferred payments, etc. Because unless there's a real need of this owner for liquidity, it seems like they're fairly motivated, and the deal itself is cash flowing. This is definitely not a distressed business as long as everything that's being reported is accurate and true. I think that it would make sense for the seller to stay on and structure something like this, especially for the right buyer. All right. That being said, the transition and support is there, so I would probably leverage into that. And then maybe in creating a business case to try to convince the seller that you're the right buyer, and then maybe partner with you a little bit more, right? Whether it's, as a minority equity holder or some sort of, note holder based off of the structuring of the financing of the deal, the terms that you negotiate. I would present a proposal to them, perhaps. So within the diligence process going into this deal, I would perhaps take the time, effort, and energy early and often to actually itemize what a plan would look like for growth and improvement. How you're going to essentially build, what we call over here at Bootstrapper Capital, Simple Broker, Simple Profits, the simple platform that we have, wedge equity, which is the incremental value inside of the business that could be built systematically over time by growing your brand equity and improving your operational equity, which reduces the risk ratio, right? So I think that there's something that you can actually leverage in terms of doing the hard work through the diligence process, which will help you diligence the deal better, to then position it with a better foot forward into the deal and negotiate, overall a better structure with better terms and better buy-in and alignment. So I think there's something to be earned here, is what I'm trying to say, in negotiating the right way. All in all, a good deal. It's nice to be able to review something like this. If you're interested in this deal, reach out to us. Let us know. Go to simplebroker.ai. We would love to represent on the buy side of this deal. And if you're interested in other deals like this, sign up for simplebroker.ai, sign up for the newsletter over at Simple Profits, reach out to us or, one of the brokers on our team. We do this every single day. It's what we love. We quite literally do build, buy, and sell simple profit businesses every single day. And we're building our own portfolio of businesses and brands over at Simple Holdings. We're partnering and financing with profit-led businesses over at Bootstrapper Capital. And then we're supporting businesses through the entire process, through the ecosystem that we're building. Hopefully, till next time, trust the process, commit to the journey.